Hello everyone. So people who've been following my channel closely, they know that I've been making a series of videos on share trading. Try to explain in basic terms what share trading means, and I also explain, why if you're outside of India, for example, why share trading is so much so easy. What's the reason I'm making these videos? Especially, I made a video in Tamil about, what are the shares that I bought, and I'm going to basically suggest to you on what shares I've bought and how much money I've made from them. That's the primary reason why I'm making this video. I was not aware of this process. I was not aware of the ease in which you can make money and ease in which you can research into a share in a country like UK, for example. And because I made money, I just thought, I will share what I have learned with, of course, my YouTube viewers. And that's the only reason. I don't get a brand endorsement. I don't get I don't have a tie-up with any of these companies. I don't have a tie-up with any of the apps that I'm suggesting to use. I'm not getting a revenue share from them. This is not a brand endorsement, nothing like that. It's practically because I made money and I just wanted to share with you guys how I made money, and see if it's useful for you, even for a small amount of investment. Again, like I said in my first video, usually my content is risk free, but from a share trading perspective, you need to do a lot of research. From a company perspective, like I said in the India versus UK comparison, the terminologies are very different. The terminologies are very easier. All you need to do is just buy and sell a share. That's all you need to worry about, nothing else. But the share that you buy, obviously you need to sit down and do proper investment, proper research. And that's what I'm going to explain today: how to do the research, how did I choose these four companies, for as an example, and how it made money for me, or how I'm expecting that it will make money for me. So these are the four companies that I had suggested in my Tamil video, and I haven't even rubbed it off. It's from the previous video. It was from last week. I'm going to come to this in the end. Before that, we'll see two or three fundamental reasons why a share price goes up, goes down, and then we'll go into this share. Then you'll be able to better understand why I'm suggesting these shares, and how I decided on these shares and how I made money from this. If you had seen my introduction video about shares, where I had explained the basics about shares, I had given some examples where a share price falls drastically, from whatever value it was to about 95%, it could lose. Like for example, the COVID-19 impact I explained about Finabler, where the business itself was impacted, and the share had fallen drastically. And then there are shares like oil prices, where the market itself is not conducive. Like oil production is higher, the oil consumption is lower, the demand is not there, so the prices will fall. So there are fundamental business reasons why the shares will fall, why the shares will increase. But after you have done all the research and you buy into a share, there are other reasons also because of which a share price could fluctuate. And it is very important to understand these fluctuations, because the reason is these fluctuations are happening without an impact to the way in which the company is performing, without a way in which the business is performing, which means that there is a full potential possibility that if it's because of these reasons, then the share price is expected to rise again. So we'll look at what these reasons are. Typically, one of the common reasons why a component's or any product's price goes down is because the supply goes up. Like for example, if there is a seller who's selling one shop where it is selling onions, then the price is at, let's say, 100 rupees. But then if there are like 10 sellers selling onions in the same street, everybody is selling onions, then there's competition, then there is supply is more and people have more choice, and which automatically means that the price will come down. When there's more supply, when there's more sales happening, the price comes down. So this is true to shares as well. When a lot of people are selling a share, when a lot of shares are coming into the market, the price comes down. These scenarios in which the number of shares available or being sold in the market can be very high, which will drive the price down. Those three scenarios are basically FPO, further public offering, placement, and shorting. So in FPO, there is a dilutive FPO and non-dilutive FPO. But FPO is basically further public offering. Now we talked about initial public offering, where when a private company, they decide to go public, they sell about, let's say, 1,000 shares to the public, and they make money out of it. What do they do with the money? They invest in the company and they are growing the company. So further public offering is very similar, wherein, let's say, there are 1,000 shares in the market. They can decide to release another 500 shares or maybe even another 1,000 shares and to the public basically. So and they'll have a prospectus and they will release it and announce it to the public, and they will release more shares. Now, when people have bought 1,000 shares, the company's value is remaining the same in FPO. So which means that suddenly when there's 1,000 more shares, the market is getting diluted. And sometimes it could be non-diluted because let's say there are 1,000 shares in the public market. Some of the shareholders of the company, they could be selling their own shares in bulk. Like for example, if a CEO has got out of the total of 2,000 shares, only 1,000 has been released to the public in IPO, and they are controlling, let's say, 500 shares. If they decide to sell the 500 shares, then extra shares are not being introduced at that point. That is non-dilutive. Dilutive means when they're creating new shares, like there are only 1,000 shares to the public. Now they're creating 1,000 new shares to the public, which means the share value is getting diluted because the company's value remaining the same. But regardless, the fundamental reason why they are doing an FPO is because they want to get more money, invest more money, and grow the company. So again, in normal circumstances, if the company is doing well and they're not trying to do a debt closure, the FPO would mean that the company could do much better, which means that the price could go up immediately after it has gone down. Placement is very similar, but the only difference is that it's not done to the public. It's not given to the public where the public has the option of buying these shares. Placement is generally when an additional chunk of shares is being given to one private investor or a group of private investors. This is again an easier method for any company to raise money instead of going and giving it to the whole public and they're going through the prospectus and FPO. This is in easier terms. This is having less control or less formal process involved, where they can just give it to one private investor who is willing to buy an additional chunk of shares from the company. And again, the placement is also done because they want to get a lot of money into the company quickly, which they can use to invest or grow the company instead of doing something else. Now, the disadvantage of placement as compared to FPO is that the placement is generally given at a discounted price to the share. So let's assume the share price is $1. Generally, the placement is given to the private investor at a small discount because they are buying in bulk. Like for example, if onions are being sold at 10 rupees per kg, right? And somebody, private investor is coming and saying that I'll buy 1,000 kgs of onions. It is common tendency that they will give it at a discount, let's say 8 rupees. So, he's buying in bulk. So same scenario here, a private investor is coming and buying the shares. But now the private investor is going to again either sell the shares, or because he's bought it at a discount of 8 rupees, let's say, the tendency is that the market price will come down to that whatever placement price that it was issued at. So if it was going at $1 and it was issued, if the placement has happened at, let's say, 75 cents or 85 pence, then the market price will also tend to come down quite quickly to that placement price. But because of the reason behind the placement that the company is trying to do good, the market price will again quickly increase back to the original value of the price. The third option is shorting. Typical shorting process, only 3 parties are involved. There is a broker. A broker is someone who holds a large number of shares, and he can sometimes sell it or he can sometimes lend it to someone for a collateral for a small price, instead of paying the whole amount. And a shorter is someone who's actually doing this process to make money and explain what this process is in the public. So what happens is in the beginning of a day, the shorter will borrow. If a stock is having a lot of public attention, if the stock is attracting a lot of public attention, that's when the shorters actually come into play. So the stock is doing well, the company is doing well. Let's say the stock price is $10. So in the morning, let's say the stock price is $10. A shorter comes to a broker and he borrows 1,000 shares basically from the broker. So he's not buying the shares, but he's borrowing the shares with the assurance that he'll give it back. He'll give the 1,000 shares back in the end of the day. Now what he's doing is he's going and immediately selling all the 1,000 shares to the public. And he's selling it at the $10 base price, which means he's got the $10,000 from the sale of this 1,000 shares. Now, when 1,000 shares are being sold at a time to the public, at that particular point, because there's $10 share price, they've given it and he's got the 1,000 or he's got the $10,000 now. But because somebody sold a large amount of shares to the market, there's a panic that is created and the public starts to either do a panic selling, which means that the expectation is that the share price will come down. Let's take a typical example when the shorting works. After some time, if this happens in the morning and the market has reacted, after some time the share price will drop to $5, let's say by the afternoon or by the evening. Now, what the shorter will do at this point is he'll wait for the share price to drop to a significant value. And once it has dropped, let's say in the afternoon, he will buy back the 1,000 shares at $5, which means that he's spending $5,000. So he got $10,000 from the original sale and he's spent $5,000, which means he's immediately made a profit of $5,000. And he will return the stock that he got to the broker. So he'll return the 1,000 shares. So from a broker's perspective, the shorter basically borrowed the 1,000 shares. He's returned the 1,000 shares. He'll probably pay a small fees to the broker, and the broker is happy with the small fees that he's got. But what has eventually happened is the share price has fallen from $10 to $5. The person that got impacted was the public, because they have now sold it back to the shorter at a shorted price, which means the shorting has worked in this scenario and the price has fallen down significantly. It will take a few days for the public, or maybe even 1 or 2 days for the public to realize that something like this has happened. And then the market will slowly pick up again. But for that particular day or for that particular couple of days, the shorting will work and the shock sale would result in a sudden drop of the share price. So these are 3 common scenarios where regardless of the company's performance, regardless of whatever else is going on with the company is doing quite healthy, the revenue is the same, the market is still the same, but there's external factors that have got impacted either through an FPO or through a placement or through a shorting, and the share price has suddenly dropped. The reason I'm saying this is because if you buy a share and if you see the shares are suddenly dropping or the share price is suddenly dropped, you need to do a bit of research to see if any one of these 3 has happened. If so, don't panic and don't sell your shares urgently in a big loss. If the company's done really badly, or if there's something major in terms of market crisis that happened, like I explained in the Finabler, where the COVID-19 had directly impacted it, the share had crashed literally 95% of its value. That's a typical market impact because the company is doing really badly because of certain circumstances. In that scenario, you need to do a panic sell before it actually crashes to the bottom of the share. But if these kind of things happen, then you need to be patient and you need to make sure that you're not selling your share, because the company is not doing anything bad, the company is still doing good. So these are some of the fundamentals that we need to understand and keep in mind. This week when I made the video, I explained 4 shares which I have invested in the last 2 months and how I made money or how I'm expecting to make money. So I'll explain the same shares and I explain some of the price differences that have happened from last week to this week. So the first share is something that I've explained in the beginning of the first video, where I explained about what share trading is, and I use this as an example. It's the share called NCYT or Nova CYT. And last week, when I explained this process in Tamil, the value of the share was around £4. So the other company that I've invested is AVCT or Avacta. Now both of these are pharmaceutical companies. The value of the share last week was £1.2. And the other third company that I had invested or explained about was GGP. It's called Greatland Gold. And the value of this one last week was roughly around 8 pence. So in pound value to 0.08. And the last company that I explained last week was MOS. It's called Mobile Stream. And the value of this last week was basically 0.3 pence. So 0.3 pence in pound translation is 0.003. That is what 0 pence looks like. I actually put the decimal point incorrectly last time. Even though I said 0.3 pence, I put the decimal point incorrectly. So I'm trying to make it correct. So why did I choose these shares? So NCYT as an example, I had explained it even in the Finabler and NCYT example in the other video. This was a company that came up with the most accurate PCR testing. That is, when you have COVID-19, this was a pharmaceutical company that came up with the most accurate PCR testing, where they have to also make sure that all of the variations, all of the different assays of COVID-19 are being tracked in PCR, and it has to be very, very accurate. And this was a company that was a very small Anglo-French company, and the share value was around 15 pence. Roughly in end of January, and it grew to almost 4 pounds. It even touched 5 pound at one point. Now, when you look at the company had very good product, and the product was acknowledged. It had FDA approvals, it had European approvals, and it was a tiny Anglo-French company that was selling to maybe 15 countries or 10 countries, started selling to about 100 countries. They released something called as an RNS, regulatory news update, which if you go to lse.co.uk, which is the London Stock Exchange's main website where all the RNS gets released, you can see all of the historical RNSs too. You can start to see that the company is growing, their manufacturing capacity is increasing, they're signing up manufacturing partners, dealerships, and they're selling in nearly 100 countries, and they've slowly ramped up. And I started buying it maybe when it was around 1 pound. And last week it was around 4 pound. Today it is about 3 pound 20 pence. Now, in the last week video, I had explained that, look, it started out from literally a 15 pence company. So it has already had its run. It has already, increased by 20 times, 30 times. And when I bought it, I know it was around 1 pound, but it was still expected to go to around 3 pounds minimum, which is why I invested in it. And when it reached, let's say, 3 pound or 3.5 pounds, I did sell half of my portfolio, which means that I took out my money. I also took out some profit out of it. Let's say I had £1,000 invested in it. When it was around £3.50 and I sell half of my portfolio, I'm getting nearly more than £2,000 worth of investment from it, or return from it. At which point I've got my investment, I've got my profit also. Now, whatever I'm still keeping in it is basically I'm just expecting it. If it goes higher, I will sell it. If not, at least I'm not making a loss from it. I've already made significant profit from it. That's one of the investing strategies. Once it reaches at least double the value that you have invested in, sell half of your portfolio, which means that you've got your money and you got a little bit more back from that investment. Whatever it makes from that point onwards is your profit. Do not wait and do not keep all the portfolio once it has crossed at least double your investment. At least take out your investment and a little bit of profit. So from that point onwards, whatever money that it makes is completely profit for you. You're never going to make a loss, like if it falls significantly. So at that point, I explained that it might have already peaked, so there's no point investing in it. But it was one of the examples. How did I do the research and how did I find out about it? The other one is Avacta, which is again a pharmaceutical company. If NCYT made a PCR testing, which is when you're having the COVID-19, you're trying to find out whether you have it or not. Avacta is basically an antigen testing. An antigen testing is once you've had it, and once you're cured, depending upon your antibodies, it's trying to find out whether you've had it or not, whether it's safe for you to go back. If you were not tested during COVID-19 for the PCR testing, then you could be tested after you've had the symptoms and you've never gone to the hospital to find out whether you really had it or not. That is the antigen testing. Again, Avacta are a company that really created one of the best antigen testings out there. And their share price was around 50 pence roughly when I invested in them. And last week it was around 1 pound 20 pence. Now today they touched nearly 2 pound and it is sitting at around 1.92 pence. So roughly from 50 pound investment, it is almost 4 times the value that it is today. And even from last week, it was around 1.2 pence, 1.2 pounds, to 1.92 pounds. It is like a significant 50% increase in value from what it was last week, nearly 50%. So the third one is GGP or Greatland Gold. So one key thing to do is, if you're starting to invest and putting in a decent amount of money, you need to diversify. You can't keep all your stocks in one industry or one basket. For example, you can't keep all your stocks in oil, or you can't keep all your stocks in pharmaceutical industry, which is why I'm diversifying the stocks. And GGP is a gold mining company in Western Australia. Recently, they've found one of the mines drilling mines called Haverion in Western Australia, where the quality or the grade of the gold that they have released in the news articles in RNS is supposedly one of the best in the world. Like in Kola goldfields, for example, they mine the gold in there, and sometimes the mine fields belong to the government, sometimes it's given out to the private drillers, and GGP is one such private company where which has gone public and they have a share. So because of the grade of the gold that has been identified, it's expected that their share price will go up. And if you look at the history of gold mining companies which have hit this kind of gold, their share prices have gone up, which is why that was one of the choices. So again, you can read about GGP. GGP, although it's an Australian company, it's an Australian mining company, they have registered their share, they have listed the share in London Stock Exchange, which is why it is traded in London Stock Exchange. So their share price last week was around 8 pence roughly, and today it is around close to 9 pence. It's roughly around, let's say, 9 pence, which means that significantly it has gone up, and it's about 10% investment jump in 1 week. And this is one share that is expected to go up as well. And finally, MOS, Mobile Stream. This is a mobile content distributor where big media firms, like for example Warner Brothers and those kind of media firms, not YouTubers like me, not small content providers like me, big content creators like Warner Brothers, if they're producing content, this is one of the partner companies that they sign up with to distribute that media quite quickly and rapidly into social media and into basically everywhere that they can distribute that content into. So they have tie-ups. On the one hand, they have the clientele is like Warner Brothers and big clientele. On the other hand, their digital tie-ups or the technology tie-ups is with big media giants like Facebook, Twitter, and social media giants like Twitter, Facebook, and all of the common names and brands they work with. And so the value offering is really good. The technical value offering is good. They stand well integrated on both the client side as well as the technical side, which is why. And also the share value is really low at this point, which means that there is a lot of potential for the share value to grow. So penny shares, like the value of the share is in few pennies, especially below £1. They are all called as penny shares. And penny shares are less riskier than shares like Google or big companies where the share value is already reached like $100, or like Tesla, for example, it reached like above $500. One share value is above $500. So if you're investing small amounts, like 20 pence, 50 pence, 100 pounds. If I'm putting 100 pounds into the market, Tesla's, I can't even buy one share of Tesla. I can't even buy one share of Google, which is nearly around $1,000 or $1,200. So for small amount investments, penny shares are really good, which means that even if I'm putting 100 pounds into it, I'm getting nearly 1,000 shares of MOS, for example. So MOS was sitting around 0.3 pence. Today it is sitting around 0.36 pence. One of the reasons is because last week or closer to the time that I was making this video in Tamil, Mobile Streams MOS had a placement, which means nearly they issued 1 million shares at a discounted price, and still it recovered and it is now higher than what the value was last week, which means that the value in the company is still good and the market is still trusting the company. So these are some of the examples, and so far the shares that I've chosen in such a way that I have trust in the company, that the company is not going to go bankrupt, the company is not doing a product that is impacted by today's market. For example, none of these are impacted by the COVID-19 situation. None of these are having a direct impact, even if the lockdown is continuing for, let's say, another couple of months or few months. So the market is not significantly impacting us. Touch wood again, anything could happen. One of these companies could lose value, but those are the parameters that you look for. The company is having a stable product, value added product. The company's share value is already not skyrocketed to $500 or $1,000 or whatever it is. Still in a reasonable price, which means that if you're putting a small amount, you can still buy a chunk of shares. Now, one word of advice is that not all of these shares are available on free trade or 212, these kind of platforms, which are low brokerage platforms, which means that they don't offer all the shares. They offer only a few list of shares. They don't offer the full market. If you're using something like a HNL or an AI, those kind of products, Hargreaves and Lansdowne, for example, then you can buy all of these shares It's the full market. So all of these 4 shares are listed at the London Stock Exchange. And it's easier to research in the London Stock Exchange because all of the companies release something called as an RNS, regulatory news update, which you can go and read in lse.co.uk. I'll give you the link to the LSE links for all of these 4 shares, where you can go and read the RNS. You can understand at what frequency they're releasing the RNS, and you can read more about these companies. Now, another example that I can give outside of these 4 is another company called TILS. So again, another biopharma company. It's called Tiziana Life Sciences. Now, Tiziana Life Sciences, I bought them, let's say, at an average price of around, let's say, 60 pence, roughly around 2 months back, beginning of March. Now, as soon as I bought it, the company wasn't doing anything different, but because some of the other companies were doing better in terms of the value offering that it had, the value of the share dropped to around 40 pence or maybe even 35 pence at some point. But when you look at the company, when you look at the RNS, when you look at what they're doing, they had a solid offering, they had a solid product lineup. It was only a matter of time before they launched their products into the market, or they gave more updates about their products into the market before it went up. There was no reason why the drop should have happened. So fortunately, I was able to hold on to the share. I didn't sell the share at a loss. I haven't sold any of my shares at a loss so far. I was able to hold on to the share, and it slowly grew, and from 35 pence to 50 pence, and it went to about 60 pence roughly, let's say last week. But today it is sitting close to around 95 pence, which means that I'm in profit. I'm probably made about 50% profit from that share if I sell it today. I haven't sold it, but that's an example of how long you could wait, like 2 months, that you might need to wait before you actually make a profit. Not all shares will make you a huge profit overnight. You need to have a lot of patience when you're buying these shares. So again, I've taken my time and explained my shares, how I've invested in them. There is no reason for you to use this list. There's no reason for you to invest in these shares. Go do your own research, but you can use this as a basis. You can understand how I've done it, and you can probably use that as a basis for you. Again, I'm not a financial expert. I'm not claiming to be a financial advisor. So do not take my word for it when I'm saying that I made money from it and you can try and copy it and do exactly the same. Do your own research. Go and read up on these shares. Go and read up, and then you will find out how you can do your own research once you understood how these shares are, how I picked up these shares. So hopefully this has been useful to you, and if you find it useful, do post your comments. I'll see if I can try and do one more video to just finish it off and finish off the whole series.